INSEAD alumni, dear friends of the INSEAD alumni community, a very warm welcome to the much anticipated Economic Outlook 2024 with Antonio Fatas, Professor of Economics at INSEAD. I'm Anne F. Ensman, the Executive Director of Alumni Engagement at INSEAD, and very pleased to share that we have had over 3,000 signups for this lifelong learning webinar. And maybe this is no surprise, because in this ever-changing world of global economics, Antonio has been a guiding voice, providing insights with clarity and answering questions to the point. He has garnered multiple Best Teaching Awards and is a sought-after commentator in the press and other media. Antonio, many thanks for joining us for the fourth year in a row already, even though you're currently on sabbatical and deeply immersed into research on inflation and unemployment. Antonio will be joined today by Franz Blom, President of the INSEAD Alumni Association. Franz is an MBA in IDD and an IDP C20, and he will facilitate the discussion today. Many of you have already submitted their questions before the webinar, and they have found their way into Antonio's presentation. But of course, you're very welcome to also ask your questions live. Please put them in the Q&A tab. You can also upvote questions by fellow participants, and we'll pick from there. The webinar will be recorded, so you are able to share with friends and colleagues or rewatch if you want to. And with this, a very warm welcome again to Antonio and Franz, and over to you, Antonio.
Okay, thank you. Good morning or good afternoon or good evening, whatever you are, and Happy New Year to all of you. I guess this is a tradition. We've been doing now this for a few years, doing a webinar at the beginning of the year to get a sense of what is the economic outlook going forward, at least for 1 year and maybe longer. Now, every year I've always done the same thing, which is I start with a sense of things which are much more long-term. So some of the long-term trends that are affecting us as we speak, they're still in the headlines of the news because they matter a lot for many of the things that the world is going through. So I've decided for this year to pick a couple of those trends, in particular one which I find is crucial for the way we look at the world. Unfortunately, when we look at the world today, we all have a little bit of a pessimistic view on conflict. Obviously, we have a few wars and military conflicts out there, but also economic conflict, the idea that maybe the world is sort of separated into different blocks, and what are sort of like the traditional superpowers going to do as the new superpowers emerge. Now, there's lots of political implications and geopolitical implications here. What I want to look at is a little bit of background from an economic point of view, which is, of course, what I do, to understand how the power has shifted between all these groups and what is the likely scenario for the years to come. Now, when we look at shifts of economic power, let me start with a couple of just slides that summarize how the world is sort of split when it comes to the advanced and emerging markets. Of course, these are groups which are arbitrary, lots of diversity within each of them, but we all tend to think about rich versus less rich or any other label you have. Now, what we've seen for the last decades is sort of a shift of power away from advanced economies. I don't think this is a surprise to anyone. Advanced economies used to dominate the world with about 63% of the world's GDP. That number keeps coming down. It was above 50 in the year 2000, and then we've seen a really fast drop from the year 2000 until last year, where now you see the dominance of emerging markets all the way to 60% of the world's GDP. Now, within emerging markets, as I said, there's a lot of diversity. What are the regions? What are the countries that have done this transformation? Well, the answer is quite simple, because if you split emerging markets between emerging Asia and the rest, you're going to see a lot of the action here. Now, I'm going to split the advanced economies as well for you, so you see a little bit more detail between US, European Union, and others. Now, a couple of highlights here. The shift towards emerging markets can be 100% explained by the shift towards emerging Asia. If you look at that change, that's what dominates the emerging market share. The other regions, whether it's Africa, whether it's Latin America, they have not changed their share of the world's GDP that much. Now, be careful, this is share of the world's GDP. If you do other emerging relative to advanced, they're still gaining ground because advanced are losing ground. Now, among the advanced, who's losing the most ground? Clearly the European Union, that has gone from 25% of the world to only 14%. So that's the part of the world in the advanced world that you're seeing a bigger shrinkage in their influence. The US has lost influence as well, but at a pace which is slightly smaller. So sort of this is the sheet of power that we've seen within emerging Asia. I can give you more details. I don't think there was going to be a surprise. Who among emerging Asia has taken that space? Once again, it's going to be a couple of players, in this case, India and China. So if you highlight within emerging markets, India and China, they basically have done most of the action. Any emerging market other than China and India have kept a share of the GDP, which is quite similar to the 1980. So Asia matters. Within Asia, a couple of countries matter for a good reason. They're large, but also China in particular has grown incredibly fast over all these decades. Now, how did they get there? When we see this growth, when we see this increase in power, where is it coming from? Now, for those of you who've attended any of my lectures, you know that I like to separate things between what I call productivity, what I call population or demographics. Now, those two engines have played very differently over the last years. In advanced economies, what we've seen is both of these engines have slowed down. The one that I like to call productivity, which here I measure with GDP per person, GDP per capita, has gone down from about 2.2 to a number which is very close to 1. Now, you see a little bit of an increase in the recent years. This is not quite what I would like to call technology. What you have here in advanced economies is a push to squeeze the labor market, to have more of the population being engaged in the labor market in a way that counteract the flatness of productivity. So I wouldn't say there's a lot of great news there in terms of productivity. This is a little bit of a blip that comes more from the labor market. Now, demographics is more straightforward. It has gone down by half, this engine. And if you look forward, of course, it's going to go down even more. Now, what matters is that the growth rate of these economies has gone down by half, from about 3 to a number which is closer to 1.5 or slightly above 1.5. Now, emerging markets have done something which is different, a very different shape. Technology looks like an inverted U. So GDP per capita during one decade, the 2000s, exploded in a way that is very visible here. It's very visible when you look at the world. The world started growing a lot faster in that decade. Now, unfortunately, for the last decade plus, about 13 years, that growth rate has come down again in a way that is a little bit frustrating and a little bit underperforming relative to the expectations we have. Now, if I were to separate regions here, again, emerging Asia probably has done better than other regions. What we see here is very much a slowdown of regions like Latin America and Africa that did very well in the 2000s and are sort of coming down to levels of performance that resemble more what we had seen before. Now, demographics, interestingly, have done the same thing as for advanced economies. They're halved. So the trend towards lower demographic growth is the same in advanced as in emerging market. It just happens to be that, of course, population growth is faster still in emerging markets. Now, the big number that you want to see here, advanced economies as we speak are growing at 1.6, 1.8% at best. Emerging markets are growing at 4%. So as long as we keep a ratio of 4 to 1.8, we're going to see continued increase of emerging markets when we do the split in the world's GDP. Now, what about going forward? So that's sort of after today. So what to expect over the coming years? Now, if you look at the three key drivers of growth, demographics, more people, labor market, more people working, productivity, more people working at a more efficient level. If you look at the advanced economies, I'm going to put a couple of arrows here. Demographics is looking that is going in the wrong direction. I'm almost 100% sure that's not going to change soon. So that's a definite negative arrow for advanced economies because fertility rates are very low everywhere, and we don't see any increase in fertility rates. The labor market has done well until today. That's sort of the green part of that arrow that you see there. But going forward, it is less clear that it can do as well. As I said earlier, we squeeze the population in some of these markets to find people who were not working and put them to work. But that has a limit. At some point, we squeeze all these pools of unemployed people or people who are not active. At some point, what would matter is we're going to continue aging. And what would matter is how we hire things like retirement age. That's sort of a key factor there. To me, the arrow remains negative. The question is how negative it will be. That depends on retirement age. Now, there's another word that I could have written there, of course, which is immigration. The way we handle immigration could make a big difference for the way we think both about demographics and the labor market. And when it comes to productivity, we come from a downward trend. And for any of you who's heard me speaking recently, I've been very pessimistic and negative about technology. At the same time, we always like to dream. We have lots of things out there that could be revolutionary. Artificial intelligence is one of them. So if you want to turn around that arrow, I would still say we need a big push towards something which is large, something that is like artificial intelligence in a way that touches all sectors, in a way that adds value, not simply that we keep using buzzwords right and left when we go to work. So that's sort of for advanced economies. Emerging markets are not too different in some ways. Demographics are pointing downwards almost everywhere, in fact, everywhere. Of course, population is still growing faster, but it's growing at a slower rate every year, every decade. The labor market is supposed to improve. Many emerging markets, if they're capable of mobilizing the labor force, you could potentially have more people working. And the key element here is a little bit like in advanced economies, productivity has not been doing very well, in particular in the last decade or 13 years. Now here, if you want to see a green arrow pointing up and you want to see more of these countries catching up and growing faster, the key word here is not artificial intelligence, although artificial intelligence could also help those countries. The key word here for me is reform to be able to sort of bring the levels of investment, the levels of convergence towards advanced economies at rates which are a lot more consistent with what you would expect in these countries. Now, let me just say a couple of words about something that is related to this long-term trend, which is this idea of like shift of powers, tension, wars, economic wars, and the possibility of sort of decoupling between different regions of the world. In particular, we sort of envision maybe a region of the world which is more aligned with the West, with the US and Europe, a region of the world which might be more aligned with China and others. Now, is it happening? Now, here I'm going to send you to places which are going to give you sort of mixed signals, because that's what the reality is. On one hand, there's lots of words among politicians, governments that say we need to do this. We need to find ways to be strategic and find a way to be independent and resilient from this geopolitical tension that is not going to go away. You see that, for example, in the US, let me put some numbers attached to those words. I'm going to show you construction in the manufacturing sector in the US. And this is measured in dollars, which are adjusted for inflation. So what you see here is, when I say construction, think about factories being built for the manufacturing sector, as simple as that. This is what we have seen recently. If you look at the scale, we sort of have multiplied this number by a factor of 2.5. Now, that's a really large increase, an increase which is very much motivated by policies, the industrial policy of the Biden administration, which is very much encouraging this type of behavior. To be clear, some of these investments are not done by domestic companies, they're done by foreign companies, but what matters is there is a little bit of a return of manufacturing to the US. Certainly the pace at which we're building factories is a lot faster than what we saw before. So this to me is a sign of some decoupling, reshoring of a sector, which is very much into the minds of politicians in the US, which is manufacturing. Now, at the same time, I don't want you to finish with a slide like this because it will be very misleading. The world has not decoupled that much. So if you look at other indicators, you might see things going, in fact, backwards. Let me show you a couple of those. China trade, international trade in finished vehicles. Most of these things are cars. So things about trading cars. I'm going to show you exports and imports of China with respect to the rest of the world. Now, what is red? Exports. How many cars China is selling to the rest of the world? Now, again, look at the scale. That is by a factor of 5. And that's quite recent, in fact. These are the months that we've been talking about decoupling. China has been doing the opposite when it comes to international trade of cars. So here you see the reality of business that I'm sure all of you are very aware. One thing is the political view of the need for decoupling. The other is the economic reality of what it takes to be competitive or not, and how easy it is to reduce or change these trade flows. Let me show you a second one, which is also an important one. We're talking a lot, of course, about energy transition in Europe. One of the energy transition key drivers is solar energy. Let's think about, where does the European Union buy panels from, solar panels? Which are the countries? Do we see the European Union trying to buy solar panels from countries that are friendly in case there is more tension out there in the world? Well, this is the distribution last year. This is a year old, this data of where the European Union bought panels. In case you cannot see, that red is China, which is 96% of the exports or the imports of the European Union of solar panel. Very little diversification here. Now, let me do one more about decoupling, trying to sort of go against some myths about decoupling. There's a lot of talk about this. This is a headline from the Financial Times, which I'm about to say is not very correct or very accurate. Sort of the end of US dollar dominance because you have a hostile takeover coming from China and maybe as well from some technological advances in sort of payments and currencies associated to crypto. I'm going to focus more on China more than crypto. Now, there's a little bit of this. I take an article from the Financial Times, a different article. This is the share of foreign reserves, countries that keep other currencies, central banks and governments that keep other currencies, the share that they keep in US dollars versus renminbi. Now, the US dollar is declining, the renminbi is exploding. Now, be careful. I've been hiding some data from you here in this slide. I didn't put the scale. Let me put the scale. The scale will tell you that these numbers are still not comparable at all. While the US remains above 60% and is very much flat in the last decade, the renminbi has barely climbed to about 2.5%. Now, this makes sense in a world where we have a lot of tension. There's some political reasons not to keep US dollars in your foreign reserves, as Russia, for example. So you've seen shifts towards other currencies, and China is the natural one, but we're talking nowhere sort of a defeat of the US dollar or a replacement of the US dollar. In fact, I can show you the data that in fact says the dollar is getting stronger. In particular, let's go to the big numbers, financial markets. That's where the big numbers are. This is the share of international foreign currency holdings by banks. So sort of banks trade with each other, and a European bank might hold dollars, a Brazilian bank might borrow in euros. So these are sort of cross-border holdings of dollars or assets of liabilities. So here is a picture, a recent picture of how those currencies represent a share in that market. There's lots of colors. The US dollar is in blue. If any, the US dollar has been increasing in recent years. So if you look in particular at the big numbers, which is not international trade, in fact, is capital flows, the US dollar still dominates that market. And in fact, you do not see yet a trend away from the US dollar. So again, this is another example where be careful. It's very easy to start telling narratives about decoupling, a sort of replacement of the old world and the old stories. But if you look at some of the data tells you that we're not there yet. Now, as we've done in other cases, let me take a quick pause. Let's take a couple of questions that Franz has either prepared or seen from some of the ones you sent, and then I'll tell you something else about more current, the state of the world, inflation, etc.
Excellent. Thank you so much, Antonio. As always, a great kickoff into a very broad and complex theme. Let me try to double click on three questions that might apply. Let me start with the point where you described that the advanced economies and to some extent also the developing economies are dependent on, as you said, how we will deal with retirement and how we will deal with immigration. I think that was very much linked to the demographics and the labor market, more than productivity. Obviously, I mean, higher retirement age would be a good idea. Obviously, more, focused immigration would also be a good idea. But given that we have, most of the advanced economies and also many of the developing economies are democracies, these are typically not very popular measures for politicians. And we've got in 50% of the world, we've got elections coming up. So do you see any, positives or negatives on people doing the right thing here? Because, we know what to do. The question is, of course, will it be done? And I think this is a link very much to many of the elections coming up in 2024.
Yeah, I think as an economist, I'm trying to think about recipes to rebalance some of these challenges, and migration is one of them. As a citizen and someone who likes to be a realist as well and understand the political dynamics, I'm very pessimistic that migration will play a significant role in many countries. And I'm very pessimistic because I see the reality of politics and I cannot deny it. And democracies are democracies. People vote what they feel is right for them. I might disagree with the majority, but the majority will rule. So I see very little dynamics in many countries for migration to become large enough. Now, having said that, I do not want to deny that they might play a role. Again, I'm speaking right now from Spain, which is the country where I was born. Last year, Spain had a net migration flow of 750,000 people. That is a significant number of people given the size of the labor market. This is one of the largest in history, probably. So again, we cannot deny that there could be circumstances, countries, and social situations where migration becomes large. And it does change a little bit the way we think about these dynamics. It might not make my charts or my trends disappear, but it might change the way we think about how bad or how small some of these effects are.
Okay, thank you. There's one more question, and I'd like to also pick one from the chat. So we've talked about, geopolitics, and where globalization in the past has led to a lot of efficiency, but also lower inflation thereby. The fact that we became more efficient simply helped to lower inflation. Now, I do get your point, we're not in a decoupling phase, but I think what we are observing is that people talk more about strategic autonomy, reshoring, bringing back part of the value chain within their countries. Would that also automatically lead to a prolonged period of higher inflation? Is that too easy a conclusion to draw?
Yeah, it's not necessary. Again, it's a good intuition, but it's not necessary. It's a little bit what we just went through in COVID. When you have certain events, let's say we stop importing goods from China and China is more efficient than we are. So as we replace those goods, the price of those goods is going to go up for sure. Now, economists like myself like to call that a one-time event. So prices jump, they stay higher forever. So bad news, you're going to have to pay more for those things. But not necessarily that leads to a constant inflation rate every year, which is higher than before. Now, any price shock, any jump in the price is going to make the life of the central banks harder because they need to deal with this. They cannot say, don't worry. People worry about it. And people say, wait, isn't that inflation? And they have to distinguish between a one-time event and something which is permanent. So the life of central banks will become more challenging. Yeah. But I don't see this necessarily as we're going to see higher inflation for the next decade. I don't see that conclusion.
Okay. Then let me also take one that we saw coming up in the chat. The declining productivity in both advanced and emerging countries. Could you double click on that? What is driving that? Where is that coming from?
Again, there's two ways to think about it. One, which is a little bit depressing, but natural, that says life is hard. Coming up with large innovations that raise productivity globally is very difficult. Yeah. 100 years ago, it was easy because we didn't have much of anything. Today is much harder. So that's one way to think, look, expect this. This is natural. Now, unfortunately, that might not be the final answer because when you look at the recent decades, we had the internet. The internet came out of nowhere and raised productivity in a way that is visible across the globe. So one could always say, can we have more internet? So to me, that's a more hopefully and positive view of technology, which is we can have these technologies. It might be hard to produce them, but we can have them. Now, we need to focus on technologies that look like that are general. They cannot be about one sector, one particular company. And that they're really good at creating value. And I think we failed. Again, some of you might have heard me before being a little bit cynical about our efforts in innovation have been misguided in recent decades. That's my view. I think we've gone for the easy short-term wins as opposed to the fundamental innovations. Now, all of us are facing now a couple of words, artificial intelligence, that potentially could be bigger than the internet. Now, I'm not sure yet. So if you ask me to bet money, I'm not sure how much money I would bet, but certainly that has opened the doors for possibilities that maybe the trend gets reversed, no doubt.
Okay. Well, let me pause there and hand back over and we'll talk soon again. Thank you.
Okay. Now, let me switch gears. Let me not talk about long-term trends. Let me talk about what happened in 2023 and how it helps us understand 2024. Many of the questions I saw you had submitted, those of you when you were signing up for the webinar, were about this, about inflation, interest rates, government debt, and I see some in the Q&A as well. Now, let me first start by saying, when I did this seminar or webinar a year ago, there were lots of fears. Let me tell you all the things that did not happen. So let's be optimistic about the last year. We did not have a global recession, which there were lots of fears about this. We did not have something else that people call the Great Resignation. Everyone is resigning. No one wants to work and everyone is retiring. That's not what the data says. There's more people working today than before COVID. That's a fact. We did not have hyperinflation. Again, we can put labels in high inflation, but it wasn't hyperinflation. We did not go back to the 1970s. And emerging markets did not go into massive sovereign debt crisis, despite the fact that the debt was high, despite the fact that interest rates went up significantly in that year. So to me, this is all good news. And I like to think about 2023 as a lesson in resilience. Okay, I was an optimist at the beginning of 2023, but not this much. So I was more pessimistic, certainly, than what we've seen. So to me, again, it's a lesson that the world economy maybe is more resilient than sometimes we make it to be. Now, a couple of things that happened that people ignore. We had the fastest healing of the labor market. It sort of finished in 2023. Let me give you one number. How long did it take for unemployment to go back to the level it had before the crisis started? A bunch of countries, global financial crisis, it took a decade. Now, whenever you see a 12 really means infinity because it never reached the previous level. Another recession happened before. So 12 means we never made it there. What about in the COVID crisis? So you take 2019, how long did it take us to go back to those levels? Almost nothing. So the labor market recovered at a pace which we'd never seen before. And once again, I think we don't celebrate enough this achievement. Now, I know some of you are thinking, wait, but what about inflation? Didn't inflation erode our incomes, make people poorer? Up to a point, and I think we have to be careful reading the data because inflation means prices go up, wages go up. Somebody's getting that revenue from the prices, somebody's getting that increasing income from the wage, and one has to be careful and look at the data. Now, wages adjusted for inflation change in an unevenly fashion. Some people did very well, in fact. Some people didn't do very well. Let me first show you a couple of countries. I'm borrowing this from the economies. So this is increasing wages adjusted for inflation from before the pandemic until September 2023, a few months before today. Now, both in the UK and the US, wages went up faster than inflation. Again, not for everyone. There's big differences. In fact, the people with low income did a lot better than people with high income. Inequality decreased substantially in the US. Now, in Europe was not as nice, where inflation was higher than wage increases. Now, that number is not dramatic. Again, obviously, it's better to be positive than negative. Now, what happened in Europe is a lot of the inflation, in particular at the beginning, came from energy prices. These are things that we import. So this is sort of a transfer of our wealth to other countries that produce that energy. That in the US did not happen because the US does not import, is not a net importer of oil these days, it's a net exporter. Now, in fact, if I focus on the US, I can say this was by far the best years ever in the US. Let me once again look at the recovery. This is data which is sort of 46 months after the crisis had started. Where was unemployment? Where were the real wages adjusted for inflation relative to before the crisis? High, right, means good. So the horizontal axis is your wage. You want it to be as high as possible. The vertical axis is your unemployment. You want to be as close as possible to before the crisis. That's the recent recovery. The COVID recessions is on the sweet spot. Fastest recovery in unemployment, higher growth in wage. Some others had high growth in wage, but with very lousy unemployment recovery. Some look horrible in any direction, like the 1980 recession. Now, funny enough, the 1980 recession was what many people fear in 2023, because the 1980 recession was caused by the central bank raising interest rates, and people thought that's where we're heading. Quite the contrary, we're literally on the opposite place. Now, I want to highlight the US because, again, politics matter. And as you all know, the US is heading towards an election this year, which matters for them, matters for all of us. And it's a very interesting situation that these economic numbers, which are in many ways better than any other recovery we've seen before, are not perceived in a way that is positive. So there was a nice chart that the Financial Times produced recently, which does a calculation that says, look at the economic data, the hard economic data. Try to predict what the confidence of citizens, consumers should be. Compare it to what people say. So one is more objective, the other one is more subjective. Now, what is very interesting, in the US, there is a massive gap between these two lines recently. Before, there was no gap. The blue line, the red line moved together. The data moved together with the subjective view of what the economy did. Look at recent years, there's a big gap. Now, we might say, okay, this big gap comes because of inflation, which surprises us. But you don't see the same gap in other countries. I picked Germany, but the article highlighted other countries. You don't see at all the same gap between the data and the subjective view. Again, this is a big issue. Of course, if you measure that gap by political party, I can tell you that gap is massive when it comes to those who have a Republican affiliation, and is much smaller for those who are Democrats. Again, this matters for the way we digest this data, because this data will lead to elections, and elections will lead to future. Now, let me say a few words about inflation. I sit here a year after my last webinar, being a lot more comfortable saying what I'm about to say, which is inflation has been obviously very high in some countries, not others, but to a large extent today, it feels like something of the past. Let me start with emerging markets that we all forget. We always read news about the US, and it's always the US and the Federal Reserve. What happened in the rest of the world with inflation? In China, we did not see inflation. In fact, the word today is deflation. Prices are falling in China. In Brazil, we saw a spike, but a spike that was very similar to previous spikes, nothing that different from previous episodes. Inflation today in Brazil is within the range of the central bank. In India, we did not see anything special. Inflation remained low relative to some previous episodes. In South Africa, a lot of noise, but nothing too special. All these three countries have inflation targets, India, South Africa, and Brazil. All of them have inflation rates today that are within their targets. Now, the action and the surprise, of course, happened more in countries like the US, where there was a big spike. In countries like Australia, just to pick another advanced economy, or the euro area. Now, in all of these countries, we've gone up in ways that we did not expect and made us panic. But we've also come down in ways which are very symmetric. We're coming down at the same speed that we went up. How far are we from a reasonable number? Let me highlight the euro area. The last number for the euro area is somewhere around 3%. Now, 3 is higher than 2. What is 2? The target of the Central Bank of Europe, which I have to remind you is symmetric. 3 is as bad as 1. Now, if you look back at history, the European Central Bank expects a good number of years under delivering on inflation. In fact, some of those years are 2 percentage points away from 2. Now, that is not ideal. I criticize the European Central Bank in those years, so we need to be closer than 2. But this gives you a perspective. When we worry about 3, which is okay to worry about 3, we need to understand the magnitude. It's a magnitude that, historically speaking, is not that far from 2. Now, are we done with inflation? Now, not 100%, and to some extent we're not done, because there's a couple of things that we don't understand. Let me tell you one that I don't understand very well. Prices of goods and services don't always move at the same speed. This is data for the US. Prices of goods typically fall relative to prices of services. So if you do a relative price, the price of goods typically fall. During COVID, there was a big boost to prices of goods relative to inflation. Inflation was mostly in goods. Now, recently, you look at the trend, it starts going down, but you can see there's a gap. Now, what does it mean, that gap? It means that today cars are a lot more expensive than many services. Now, is that going to be forever? Does that gap need to be closed? I do not have a great answer to that question. I can have hypotheses, but again, that makes me a little bit uneasy saying all the inflation dynamics are 100% done, we're back to normal, because there's some relative prices that look still a little bit off, and we might see deflation in goods, and then we're back to normal. We might see a slightly higher inflation in services, we're back to normal, or maybe cars will always be more expensive. We enter a new world, again, coming to the question of France, maybe this is the new world where certain things are going to be more expensive than before. We just need to get used to them. Now, let me say a couple of words about interest rates. I've seen lots of questions about interest rates. Now, this is what central banks have done. Nothing special that you don't know. Central banks raise rates really fast in the current cycle, a lot faster than in other cycles. Now, we all have been guessing. So what is going to happen to the future? Are interest rates going to continue going up, going down? Now, this is a picture, in case you haven't seen it, these dots are the predictions that the members of the Federal Open Market Committee in the US, so the central bank in the US, makes about the future actions. Where are we going to set interest rates in 2024, 25, 26, in the long run, where everything has gone back to normal? Now, if you ask them in March of last year, they said, look, we're going to be somewhere around 5 by 2024, and then slowly we'll land around 2. So 2 is the number that says this is the normal number. We'll get there. Now, if you ask them in September, things were getting a little bit hotter, meaning inflation was high, and they thought we need to keep going up a little bit. So you see the dots are moving up. If you ask them in December, the numbers have come down back to where they were in March. Now here, what they're signaling is that at some point interest rates will have to come down. Now we're all gonna have to guess, is it gonna be in the middle of the year, this year? Is it gonna be towards the end? Now I will give you the same answer that the central bank will give you, is data dependent. Now, by that I mean, if nothing were to happen, by nothing I mean nothing big, it is very likely that you will see interest rates decreasing by the middle of the year. If there's a big shock to the price of oil, there's a war, there's a conflict that creates, again, some disruption in supply chain that is likely to raise inflation, and maybe the central bank will take a pause. If there is a global recession, interest rates will come down faster. So again, there's a question of pace. It's very hard to write the pace, but I think the trend that you see here, I think is a very natural way to think about future interest rates. I do want you to look at the long term. This is an important number because it says when we normalize things, we should be somewhere around 2-3%. And again, that's a very strong statement about the future. Now, how bad is the level of interest rates for all of us? How bad is for governments? Some of you are asking me questions about governments, government debt in particular. Now, let me give you a perspective which is slightly more optimistic than what you see out there. I'm going to show you 3 years, before the global financial crisis, before COVID, and last year. Now, if you look at 10-year government bond interest rates, so how much does the government have to pay if they issue a 10-year bond? We see a U shape, obviously. We're sort of back to where we were before the global financial crisis. Now, what matters for the sustainability of debt is not this number, is the real number adjusted for inflation, because the revenues of the government increase at the pace of inflation. So higher inflation means, quote unquote, good news for revenues for the government. So let's adjust for inflation. I choose inflation of that year just to keep things simple and look at the real one. Is the real interest rate higher today than in 2008? Possibly. That 2019, it depends which inflation rate you pick. The one I did, it looks lower. But the main message here, interest rates have not changed dramatically. We're talking about 0.5 point. If you want to make it look as bad as possible, I would say 1 point. Under some scenario, I would say less than that. Let me give you a second country. I'll take the country where I come from, Spain. Same question. Interest rates were a lot higher in 2008 than in 2019, and even higher than today, 2023. But once you adjust it for inflation, the real cost of borrowing 10 years for the Spanish government is very similar than 2019 or 2008. Again, I can change the numbers. I can use different inflation numbers, inflation expectations. I can move those numbers up and down a little bit. But I don't want you to think that governments live today in a world where interest rates are so much higher than before, and they really question the sustainability of the debt. Okay, they have to manage the debt, which is not easy, but the world has not changed dramatically over the last 2 years. Now, let me say just a couple of words to finish, a little bit outlook about 2024. Is this the year of the recession? Now, I'm going to be optimistic with some warnings. First, if you look at the data, this is the IMF forecast for 2024. It's sort of steady. They expect the US to slow down a little bit because it has done very well this year. They expect Europe to do a little bit better because it hasn't done that great. I'm going to show you Germany in a second. Germany has had a bad year. German GDP just came out the figure yesterday. In 2023 went down. So that's sort of the boost to Europe. Of course, you don't see massive numbers here. They're quite close to zero. They're 1 point something, but you're not going to see a 3 or a 4 in 2024. Are we going to have recessions? Now, let me remind you that sometimes it's easy to get into a recession. The technical definition of recession says if you have 2 quarters of growth which is negative in a row, we're going to call it a recession. Now, let me show you the growth rate by quarter in Germany over the last years. I'm hiding the COVID numbers because they're so crazy that the scale will go nuts. Now, Germany has been sort of flirting with recession for the last year in a way that is almost funny, because the last number that you see there, which is the last quarter, ended up being negative. The one before, the third quarter of 2023, used to be minus 0.1, but it was revised up to 0.0, which means that technically Germany is not in a recession. But again, you can see my point. It is really easy to fall into one of these technical recessions. Now, to me, this is not what we should be concerned about. We should be concerned about massive global crisis. And that's not what I see here. That's not what I see in the forecast of the IMF. Emerging markets, to be honest, they look quite steady. We have not seen the crisis that we expected. Great news, and they look quite steady. Now, quite steady with a lot of warnings. So let me now be slightly more pessimistic, or at least make sure that we all understand the risk. The World Bank published this study yesterday. So I just put it up here, the global economic prospects. They do this regularly, and they give you a sense of what the world looks like, in particular emerging markets. Their title is Subdued Growth, meaning productivity is not doing well enough in emerging markets. So there's growth, but it should be better. And then the 2 words that follow is the ones that I care about in this slide, multiple challenges. Now, let me highlight some of those challenges. There are plenty of them. You can add many more, from the current Middle East conflict to trade fragmentation, to climate-related disasters, to monetary policy, which is still an issue, to higher inflation, to financial conditions, etc., etc. Now, that is the reality that we face when we look at emerging markets and when we look at the world, which is, if you want me to talk about risk, I have a long list of things that can go wrong. So creating a pessimistic scenario is very easy. I can pick any of these things. I can create a massive global recession. Now, the big question is probabilities. Will they happen? And the second big question, where I become very optimistic in 2023, even if they happen, can the economy be resilient? Can remember our perspective when we realized in Europe that we could not buy natural gas from Russia. It felt like the end of the world. It felt like energy restrictions right and left, industry disappearing. That did not happen. We were lucky, the weather was good, but we managed to substitute away. And that's what I mean by resilient, in a way that surprised us. So we sometimes need to be optimistic about some of these risks. Even if they happen, we might be able to be resilient. Now, let me finish with a couple of thoughts. Again, optimism because of what I see in 2023. Now, do not overdo it. I'm not telling you we're going to grow really fast. Growth rates are going to look subdued. That's a good word to describe even an optimistic scenario in 2024. You want optimism, you want to dream, not hallucinate. Give me a great scenario for AI having an impact as we speak, not in 5 years, 10 years, as we speak, and then I can be optimistic about the future. Now, you want to be pessimistic. I have a long list of things that can go wrong. I listed some of them in my previous slide. There's one more that I did not mention. I hope you all can tell what that date is and what that piece of hair means. And that's, I think, a big unknown as we're looking at the fall in 2024. Now, let me stop here, bring Franz back, and then we'll take a few more questions to finish the session.
Absolutely. Thank you, Antonio. I did put my video on, but I'm not sure it works. Let me check.
It comes slowly, I think.
Okay, good. In any case, let me start. Phrasing the topic. I'd like to slowly step back to the beginning of the second part, where we talked about the speedy recovery after COVID. In many countries, I think governments had learned from earlier recessions and put in quite some fiscal stimulus to keep people in their jobs and make sure that we actually, well, protected the economy from doing too much damage to the supply side during the COVID time. That also meant we did spend quite a bit of money, and I'd like us to turn a little bit to the fiscal side of things, because if I look at, and let me zoom in on Europe for a moment, but if I look at Europe, where we've got many countries with government debt approaching or topping 100% of GDP, sustainability investments for the next 20-25 years that will be roughly 2% of GDP, an enormous task to reinvest in the defense, because I mean you just finished with the unknown in the US, so I think Europe needs to prepare for being independent on its defense, another 2-3% of GDP. How do we square all this? I mean, already government debt's very high, massive demands on well, basically government budgets, graying economies that also will top the pension payments. Aren't we up for either massively higher taxes or much lower government spend in actually already the next 5 years? Question mark.
Yeah, I mean, that's a fundamental question, and my attitude towards that question is a little bit complicated because I see both sides, and in my research, I've sort of talked about both sides. I have some work on my research, which is about how poorly governments manage their finances and how we need to constrain governments, because otherwise we're going to have a crisis soon. But I have a lot of work, in particular during the global financial crisis, that we should let governments be very aggressive at crisis time. So we should not panic during a crisis time, because then we're going to make the crisis even worse.
Yeah.
I think the COVID reaction, again, you said it, Franz, I think it was a smart reaction given how poorly we managed the global financial crisis. Now we're done with that. We had a great recovery, great news. Now, as I look at the future, I see a little bit all the challenges you mentioned. We do need to figure out how to shift resources into defense. We need to figure out how to shift resources into climate change. We have to. And that's good for all of us. This is not just for some of us, for all of us. Now, it has to come from somewhere. It has to come from either the government reshuffling their spending, or all of us paying more, or, I don't know, some miracle, again, AI that produces magic revenues everywhere, and then we have money to spend everywhere. Now, these are difficult political choices. When I look at many countries in Europe, I do not see the political climate today to be capable of delivering those choices. Now, is this the end of the world in 2024? No. But if we keep doing this, one day in one of these webinars, I'm going to say, let's run, because there's going to be a crisis tomorrow, because this is not going to work. So it's not an immediate threat. I don't see countries being under immediate threat. But again, the more I think about the political dynamics that are needed to deal with all these challenges, of course, the more pessimistic I get, because I don't see that climate in many countries.
No, that's, I think we share that view deeply. I think there's another question that came up in the chat that's combining maybe the geopolitical context with economics, and that is, to what extent do you see that the ongoing wars and crises will keep on impacting us? I think that every time there is most recently, I think the unrest in the Red Sea leads to immediate reactions around commodity prices slightly going up, the cost of transport going up. I mean, there is this almost direct interaction between, if you like, geopolitical unrest and the economic markets. in a way that I think we, until 5-6 years ago, we thought had disappeared completely. Will we learn how to deal with that, or is that there to stay with us?
I mean, I think on one hand, I see potentially more crisis ahead. I think, again, the geopolitical landscape has changed. I can tell you stories about crisis here, there, one geography, one another, and they're sort of possible. Now, where I'm becoming more optimistic, is when it comes to that notion of resilience. I did think that the war in Ukraine was going to have a massive effect in Europe. I mean, it has had it. Of course, it has had a horrible effect in Ukraine. But from an economic point of view, we sort of managed to survive to it. And I see more of these events that we all become very pessimistic. Again, even the first Trump presidency and the sort of all the tariffs that he put in China, I thought that was really going to have a massive effect on international trade. But somehow politicians and governments and businesses find ways around those clearly negative actions. So again, I'm pessimistic on the side of crisis, and from a humanitarian point of view, what we're seeing is really a disaster. From an economic point of view, I don't know, it just feels that it's almost business as usual. And maybe we should think more about that, about what makes us resilient, because we might not be able to get rid of the crisis. So maybe we should have a slightly different attitude, which is instead of being surprised, we need to build companies, countries, and economic dynamics that are ready to be resilient.
Yeah. Okay. Let me do 2 more, because I think we have time for that. Let me for one zoom out. We've talked a lot about growth and where it's coming from and how to deal with it, the optionality, I mean, the risks, the opportunities. There is a school of thought that says we should no longer talk about growth. We should talk about degrowth. I think where the world is heading, I mean, all this focus on economic growth has completely drifted us into the wrong direction. Would you mind sharing a couple of minutes on maybe how you view that debate around degrowth versus growth, and whether it's at all possible to think about a world that's shrinking rather than growing?
I mean, I think it's a good contribution to our thinking. It challenges our sort of common wisdom that is always growth, growth, growth. I feel it's very naive, the way it's being posed. I think it's ignoring the reality of the world. Again, the way I see it, if you are in an economy which is advanced, which is very rich, we as a society, because we have to decide as a society, with democracies, we could say, look, let's rationalize the race that we've had for decades towards having more and more and more. And as we're doing this, we're causing some long-term damage to the environment, to climate, and we and the future generations are going to suffer. Let's be smart about this. Now, I think we're doing some of that, but it's very difficult to say if you're in a country whose GDP per capita is below $1,000 that you say degrowth, because those countries really need to develop. And unfortunately, there's many countries where living standards are not acceptable. So it is very hard to think about degrowth as a general strategy. I'm, of course, all for internalizing the damage that we do to resources, to climate, to ourselves in the future by having an ambition which is growing, which might make us very happy in the short run, and maybe it doesn't even make us very happy in the short run. And again, to me, that's a self-defeating strategy. But I think the conversation is is full of nuances. I just don't want to say it's degrowth versus growth. The question is about rational decisions where we understand the cost of the actions we take. And in some cases, for sure, it will lead to a reduction of the current emphasis on growth, for sure.
Yeah, yeah. And I think that's a good de-averaging that makes sense, absolutely. Well, let me finish and make sure we will also end on time with one last question. And you finished with the US elections in your presentation. Now, if you were appointed advisor to the next president in the US, what would be your most important piece of advice regarding the economy?
I mean, again, to be honest, I'll defend what I've seen in the US in recent years, not everything, but I think the US economy has managed to build on its usual strengths, which is a very dynamic economy the number of people who are starting businesses in the US is at a record level today. So it's a very dynamic economy. They keep being the center of some of the innovation in technology, and that has not gone away. You've seen it recovering faster than other economies from the crisis, which is part of that dynamism. And I do appreciate some of what we call industrial policy by the US government, because I think industrial policy in the past has always been something that we thought you shouldn't do, let the market decide. I disagree. In particular, in today's world, you cannot just have the market deciding. From a strategic point of view, from a geopolitical point of view, even from an economic point of view, you need to have certain industries. And that booming construction that you see in manufacturing, to me, is a welcome sign in the US. So I think that's something that needs to be continued. Now, what I don't like, and I would like to change, is the US needs to find a dialogue with the rest of the world. I mean, both a political and an economic dialogue. Confrontation is not going to be good for them, and certainly not good for the rest of us. So now I don't have a great recipe. I'm not a diplomat. I'm not a politician. I'm not sure how you deal with confrontation and finding sort of pragmatic solutions that please all sides. Is not easy in today's environment. But I think the US starts with this idea, we can fix everything by ourselves. I think the reality is whatever we want to fix, whether it's climate change, whether it's the Middle East, again, we need to find a lot of compromises and a lot of pragmatism. Yes, ideas matter, values matter, and we need to respect them. But again, we need to be pragmatic. Otherwise, just by respecting our values, we end up in the worst possible outcome that we could imagine. So that would be my biggest advice to the next president. Of course, there's going to be two candidates. I'm not sure one of them is very much willing to listen to that advice, but that's another story.
That's entirely correct. Antonio, I'd like to thank you very much. As always, extremely insightful and engaging. I see many people thumbs up, very, very happy about the speech. I look forward to continue the discussion when you're back from your sabbatical, and latest next year, I hope.
Yep, next year I'll be back.
Thank you so much, sir.
Okay, thank you, everyone, and thank you very much for showing up all the time. Thank you.
Okay, bye-bye.
Bye.